Good morning. It's Monday, August 28th. We got 3 days left in the August debacle. It's June was awesome. July was awesome. August, my birthday month, not so awesome. We've been down ever since. I want to start off the episode with saying TrendSpider emailed me, and I'm not sure if I'm allowed to say this, but essentially Labor Day is, this is the email, Labor Day is just around the corner, and TrendSpider will be back with the hottest deal on all plans starting Wednesday, August 30th. So Wednesday, deep discounts up to 65% off. They're available for those who sign up for a free 7-day trial with the sale period with an extra 5% off when prepaid. So here's the deal. You're going to go here to to my Linktree, Linktre, or just the link down below for TrendSpider. Whatever platform that you're listening in, all the show notes have a link to TrendSpider. Go to that link. On Wednesday, you'll see the best deal. It's a Labor Day deal. It runs from Wednesday, August 30th to Monday, September 4th. I will tell you, if you're on the sidelines about TrendSpider, take it on Wednesday. I think you do. There's some type of incentive. I don't exactly know what it is, but there is some type of incentive where it basically the sale decays over time. So each day you're losing 1% off. You're losing 5% off. I think on their Black Friday last time, they were losing like 5% every day. So if during the week of Black Friday, if you waited, you lost 5% every day off the discount. So I think that's the way that it goes. But if you want, go and look. Keep looking at this link on TrendSpider. It says it's 65% off. That's one of the best deals that I've seen over the 5 years that I've had TrendSpider. 3 years that I think I've had them for about 4. So I've been using the platform. It's fantastic. You guys see me use the charts. If you just make sure you have enough in your trading portfolio to make it worthwhile. That's my only caveat. You really need to have enough money that you're trading with to make it worth the while. I think it'll come out to be about $400 for the year. You can do it by month. They'll have a monthly subscription service as well. But you'll really need to. For me, it's the year. I mean, listen. If you can't make $400 on a couple of trades. And it does save you money. Bull or bear market, the algorithms save you money, the charts save you money. Go into our Facebook group and just ask anybody who has TrendSpider. Just put up the question, is TrendSpider worth it? I think 100% of the people would vote yes. So I don't want to skew anybody, but they will be having a huge sale. Now, over the weekend, I listened to this. It's the podcast is called On the Tape. And it's running on empty with Tony Dwyer. If you don't know Tony Dwyer, he's a market analyst. He is fantastic. What I did was I went to Scribbler and I said, hey, can you summarize this episode for me? And I'll put the link of the summary in the newsletter. So if you're not signed up to the newsletter, get signed up, because it'll save you from having to listen to all the boring crap that I listen to, even though I was on edge. If you don't know Danny Moses, he's one of the dudes in The Big Short, and he's on this podcast, and they're talking about the economy. Again, the newsletter is dailystockpick.substack.com, or go to my Linktree. But in this summary, you can see it puts down the chapters, and it goes over bullet points. Danny predicts that stocks are running out of buyers and expects a market correction similar to July 2000. So essentially what they were talking about was Tony was saying, hey, when good news is good news, that's when you want to get into the market. He said, so far, bad news has been good news. And when he's talking about bad news, he means when jobs are down, that's good news, because that means the Fed is actually making sure that inflation comes down. When good news is bad, meaning that when jobs are being added, and that's good news, means the Fed has to tighten up more. And so interest rates go down. They have to stall the economy. What really stood out for me was they went over, and it's somewhere in the episode. I'm not sure if it caught it on the summary or not, but they were going over the analysts' average S&P earnings for next year. And the average S&P earnings are up about 5%, which would indicate the S&P should be up about 5%. So what's the market missing? Because, and like Tony said, you're getting 5% on a 1-year treasury, on a 2-year treasury. Why would you risk 5% on the S&P when everybody's expecting it to go 5% in the face of a Fed that wants to stay higher for longer, in the face of the U.S. paying 30% of what it takes in taxes out, it just in interest, which hasn't been something that we've had to pay in years past. Why would you want to take the risk and just not take risk-free, which would be a treasury bond? So great points. It scared the crap out of me. It did point out to me that as we're going down, I think you want to add to it. And Tony made a great call. He said, and remember, these are the, two of these guys, Tony Dwyer and Danny Moses. Danny Moses was in The Big Short, but Tony Dwyer was one of the guys who was one of the analysts going to the office with Danny Myers, talking to him about, what they're seeing in the economy. So you got two of these guys who made one of the greatest calls in history, who were basically saying, hey, the market's going to crash. They're saying that the market's going to crash again. But Tony points out, and it's brilliant, he said the one thing that you didn't have back in 2007, 2008, where it was possible, this crash, you're absolutely 100% seeing that when something happens like Silicon Valley Bank, the Fed immediately jumps in and jumps in big. Now, mind you, that Silicon Valley Bank stuff could have gotten out of hand. The Fed jumped in and said, nah, we're not going to have it. We're just going to save it. And they didn't call it a savings program. They didn't call it a rescue program. They named it something else. You can name a tiger whatever you want. What's the thing that, if a fucking horse has a horn on it, it's a fucking unicorn. You can't hide a unicorn. So it is what it is. And he said the Fed's going to save it. Don't fight the Fed. But he did point out, when good news is good news, that's when you want to get in. That right on the screen, you'll see this is SPY. And SPY right now is at 439 in pre-market. You're at 442, up about 0.5%. It does look like it's a green market. You can say we've slightly pulled back on the this is the weekly. So this is the weekly. Slightly pulled back on the MACD. But one of the things that I want to point out on the weekly, we'll go to the 4-hour and see how the 4-hour looks so you can see. But one of the things I want to point out on the weekly is SPY last week had an inside week. And so what an inside week means is you can see this, the low was 433 and the high was 448. That was 2 weeks ago. Last week, the low was 435, which is above 433. And the high was 445, which is below 448. So you have an inside week, meaning that candle is inside the last week's candle. There have just been 7 inside weeks for the S&P in the last 2 years. The following week was green 86% of the time with an average return of 1.1%. So what do you want to do? Maybe what we do for this week is we go over to our levered ETFs and we find a bull S&P. Let's see. What is one? I should have this handy, but I don't. SPXU. It's a triple levered. That's the SPXU is the Ultra Pro short. SPXL is the Ultra Pro long. So SPXL, maybe you turn 3% this week. The algorithm had you buy in here at 88.02. You're trading at 85.91. In pre-market, you're up 1.4% at $87. I'd probably wait for a little bit of a dip maybe today because, again, your average return is 1.1%, and this one's already up 1.4. Maybe you could get 2% out of that if you bought it right now at 87. But I'll write that down. Let me write this down, SPXL. We'll check it next week. I'll put a note in to check it next week. But the inside thing really kind of pointed it out to me that, hey, maybe we want to look at this. But let's go back to SPY, and we'll run the 4-hour algorithm on SPY so you guys can see where it's at. You can see the gap down here. We're still in. MACD hasn't crossed down. MACD's just kind of fluttering there. The RSI is in no man's land at 45. Your 50-day is still going negative. Your 9 and your 21 are starting to turn around. If you see that 9-day cross up on that, on the 21, kind of bullish. So, but, again, listen to that on the tape podcast. Understand September and October are weak months as well. It's not like this is getting, an incredible turnaround at this point. So I want to talk about NVIDIA. And NVIDIA announced their buyback. And the buyback, NVIDIA, I read an article on NVIDIA. I'll include it in the newsletter, and there's a couple of things. NVIDIA shares traded at 45 times forward 12-month earnings estimates as of Wednesday, compared with about 19 times the forward earnings of the overall S&P 500. 45 times versus 19 times. That's expensive. On the tape podcast, Danny Moses points out that in July, I think 2000, somewhere in that neighborhood, they pointed out that fiber holdings were going to just shoot down. I think it was JDSU, he was saying, reported a quarter like NVIDIA reported. And JDSU was doing fiber. And essentially, they said, hey, this can't go on. There's something wrong here. JDSU went out of business and essentially never posted another profitable quarter. They were bought, I think, by Google or somebody. But that's where we're at, is NVIDIA's trading 45 times. I am not purchasing NVIDIA. I do think that we get down to this gap at 430. I don't think it's a favorite right now. They have an October event. The catalyst is not the ex-dividend date of September 6th. I think the catalyst is the event in October. NVIDIA stock buyback is the 5th biggest repurchase announcement among U.S.-based companies this year. So it's not even the biggest. Companies commonly repurchase their stocks as a way to return capital to shareholders. Such buybacks can benefit a stock's price. You've seen this in Apple. They reduce the supply of shares and increase demand and can boost earnings per share, a closely watched investor metric. So as NVIDIA buys back their shares, their earnings per share will go up, which will cause the stock price to actually go up. Here's the note. But while shareholders often see buybacks as an encouraging sign when a company's stock appears cheap, NVIDIA's shares have shot up 220% in 2023 alone, leaving investors searching for the reasons behind the company's move. Meanwhile, several other mega cap tech companies and growth companies have announced even bigger buybacks this year, like Apple, $90 billion. Google, $70 billion, Meta at $40 billion. Tech companies tend to prefer using cash for buybacks over dividends because if they are on the hook for a dividend every quarter, that may hinder their ability to take advantage of growth opportunities. That's the key issue. They don't pay dividends because once you start paying a dividend, the market expects you to continue paying a dividend. It's one thing for these oil companies to pay special dividends on top of their normal dividend, but it's another thing to actually announce a dividend and continue it forward. You see this all the time. There's a great article on NVIDIA, the valuation, as I mentioned. One green flag for NVIDIA and one red flag. I'll post that in the newsletter so you can read it. Overall, I think NVIDIA is still on my buy list. I'm not taking it out. I still I don't own it in my retirement. I have not repurchased it. It's getting up there at 460. My plan is to rebuy it. Don't know where I'll be rebuy it, but in the paid newsletter this weekend, I explained my rationale. I explained where I might buy it, price points, things of that sort, and what I'm planning on doing. Plans can always change, and this is why I don't want you to necessarily copy me. I want you to figure out your own plan. But I do think that there's a range here that I put in the paid newsletter this weekend that I think is a very good plan. This yellow line is the gap that it kind of came back to fill after it gapped up on the previous earnings. We didn't see a gap on this earnings because all of the movement was pre-market. Remember, all of the movement in NVIDIA was pre-market. By the time the stock opened, it was back to where it traded. So I want you to be extremely careful with this one. After listening to that podcast on the tape, I think we should be extra careful with this. It doesn't mean that I'm not going to buy it. It just means I'm going to be extra careful with actually purchasing it. And a good example is Marvell. And it's probably a little bit over because, again, NVIDIA is by far and away a different monster than everything else in AI. But Marvel, Christian pointed out, he said on YouTube this morning, Marvell's starting to fill their gap down. Well, what happened was, if you remember Marvell back here on May 25th, they announced earnings and they said, we're seeing unprecedented demand for our chips because of AI. And that's all they said. And I don't know that they necessarily raised their forecast. I don't remember specifics, but that gap you can see. Essentially, it gapped up. It went from, let's see, it was trading here at about 46. It went up to 64. So it flipped around. Yeah, it went up to 64. It got up to 67.99. Today, it's trading for 53.33. It started to fill that gap because when they announced earnings, they didn't see the huge AI bump that NVIDIA did. They didn't see the huge AI bump that everybody else is promising. But it's only one quarter. But it probably will fill this gap down to about 49. You'll get the 49s in there. But that's a great example of AI hype. And it's perfectly, it's within one quarter. So how fast can things turn? That's how fast they can turn. Now let's talk Tesla. Because here, this is Elon went live on X, formerly known as Twitter. He went live with version 12 of full self-driving. If you guys haven't seen this particular one, I'll put the link in the description. But it's not great quality. It's pretty grainy. It's not fantastic. It's pretty boring to watch, to be honest. There is a great, and I mean great, summary of this on YouTube that I'll include.
Elon's low-quality live stream that seemingly showed a new version.
And this one is even better to watch, AI Driver. Essentially what people are saying is that this is a moment that will go down in history. And if you don't know, so currently my Tesla, everybody else's Tesla, Joe's Tesla, anybody that has the Tesla, if you have full self-driving, you're on version 11. And version 11 gets little upgrades and stuff like that. I don't know anybody who actually trusts version 11 to drive them around the city. And the reason is because when you get to right-hand and left-hand turn lanes, it's super hesitant and it's not great. And that's why when you look at AI videos on full self-driving on YouTube, they're sped up. They speed through it because you can't see a lot of those hesitations. It's not great. The difference is, and we've been waiting for version 12, version 12 takes all human code out of the equation. What they trained version 12 with, it's trained with video. Enormous improvements. This is big for Tesla because if they can get this right, essentially version 12 could be licensed to other car manufacturers as, hey, here's your self-driving. You just have to put 8 cameras in. We'll provide you the software, and Tesla gets a licensing fee. So for anybody that sells a car with the cameras and stuff in it, then boom, they get a licensing fee. Whether the customer actually subscribes to it or not, they'll get a licensing fee. It's enormous. There were 2 things that stood out to me in the drive. The first was how smooth it was. They left the Tesla factory parking lot in Fremont, and there was construction. And Elon even pointed out, and I don't know how much you trust Elon, but he pointed out, hey, this construction wasn't there. So it's not like it pre-mapped it. This is brand new construction. Went right through the cones, and the cones were kind of, a little iffy. The other thing it did, it went through a roundabout. I was crazy. There was also a moment where the car had to make a left-hand turn, and it crossed the yellow line into a turn lane early. And the engineer that was riding, I think it was the engineer that was riding with Elon pointed out, hey, that's how most people do this, left-hand turn thing. They get into the lane too soon. They don't do the 25 feet left-hand turn. They actually get in 50 feet before. So it was clear that the car was understanding the actual human behavior. The other thing that I noticed was it never really came. I think Elon pointed this out. It doesn't stop at stop signs. And the reason is because they trained, holy shit, VFS is up at 84. God. VFS is VinFast Auto. This is the Vietnamese auto company, EV company that's building here in the U.S. It's at 84. But the reason it doesn't stop at stop signs is because they had a hard time finding video that could stop at stop signs, because typically people just roll through stop signs. And it's not like they blow stop signs. They just do rolling stops. So, there's a lot here. And understand that if they're able to actually train via video, my Tesla, Joe's Tesla, everybody's Tesla that's on the road, when you see a Tesla, it uploads that video every night to Tesla's AI. Now, I said it. Tesla's AI. What do you think Tesla is getting themselves into with AI? They're going to have a model that trains itself. They're going to be able to do what ChatGPT, what Facebook, what Google, what all of those people do with AI, and probably license it out. So not just to car companies. This is, once you get AI in there, they highlighted it in their presentation, I think a few years ago, with the robots. They're building robots. Well, they have robots, I think, running around on the Texas campus or the California campus. Tesla is in AI. Today, Tesla is up, 1.55%. You can see right down here, it kind of gapped between 216 and 220. I would assume that's the gap that we're probably going to see on the way down. Right now, you're going up. Your RSI is at 57. Your MACD is crossing up. From a weekly standpoint, I think you're still in a downturn, but it's not a major downturn. My guess, this is the last meme stock that's actually standing. I think that 200-day, if I had to guess, that 50-day is going to bounce off that 200-day, and 240 is probably not a bad buy for this one. I may take my chances on this one just based on this exact example. I just find it incredible. Now, another Twitter thread that I will put up, 10 powerful visuals every investor should memorize. And you absolutely should read this. Subscribe to the newsletter, and I'll put this in the newsletter, the link to this one, this thread. But dollar cost averaging makes market timing irrelevant. It does. Add on the way down, add on the way up, whatever you want to do. Dollar cost averaging will help you. 2, cash is short-term and safe, but long-term risky. Stocks are short-term risky, but long-term safe. 100%. This third one hit home for me. Expect the market to play all kinds of mind tricks on you. $10 to $20, you're celebrating. $10 to $30, you're celebrating. But if it goes back to 20, you're like, why didn't I sell at 30? Yeah, F you. And that's what I tell myself all the time, because I'm in that camp. Watch the business, not the stock. The business here, the stock. This, by the way, or 5, buy damaged stocks, avoid damaged companies. Damaged stocks, I would say, is something like an NVDA before. It was not a damaged company. It was a damaged stock. And the reason was they just didn't have, everybody thought, oh, there's a chip glut, blah, blah, blah. They can't sell their stuff. All of a sudden, AI comes in, they can sell it. And boom, you're seeing the revenue go up and the stock is responding. This one, avoid damaged companies. The revenue's going down. This potentially is probably Target. I mean, sorry to say, but Target, we'll get to it in a little bit, but Target, I think that's it. But these are 10 things. I think you should read through them. Absolutely 100% read through them. Target, let's speak of Target. I'm going to show you, we're going to go to FinViz. First, I want to look at the actual stock. The stock's down at 122. And we don't have confirmation. We don't have a buy on this one. You got you in at 131, got you out with a short little loss right here. The MACD's crossing down. I don't know that I'd necessarily get into this one, and I'll show you the reason. But 122, I just, I put this in as the support level before its old support becomes resistance. And this is why. This is what I noticed this weekend. Target CEO sells another $4 million in shares with the stock trading at 52-week lows. Look, Brian Cornell, $4 million on August 18th. Why is he selling at 130? What does he know on August 18th? Because he sold $4 million worth of shares. If he thinks it's going to 160 and he's selling at 130, he doesn't. This is the CEO. So it's multi-year lows. So I might sell, it's in a retirement account. I might sell my shares, just get out, throw it into Apple or something like that, a little bit safer. But Target, probably coming out of the core portfolio. I just don't believe in this company anymore. Twinkies, TWNK, I think it is. No, it's Hostess. Let's see, what's Hostess? Oh, come on. Hostess was sold, TWNK. Yeah, I thought I put that in. Hostess was bought, sold, and that line right there is what you're seeing. I mean, it's just been a lagging company. Gets you in at 27. It's up at 27.32, up 1%. The hype is out of it, but this was selling at 22 and then just ramped up. Look at the volume. I mean, the volume's huge. The RSI is huge. Don't get into this. Do not get into this one. It's, great. I mean, listen, they last forever. I'm going to point this out. Value today of $100 invested 10 years ago. I'll put these in the newsletter. Stock picking matters. 10 years ago, if you put $100 into Tesla, you're at $2,189, 200% return. Adobe, $1,154. Eli Lilly. I mean, look, it's not the grade 8. Stock picking matters. Tesla was the top one. Are you upset because you put $100 in and Nike and you got $310, or McDonald's and you got $299? It's 10 years. You doubled your money in 10 years. You should double your money in 7 years. The S&P doubles it in 7 years. So anything that didn't close to triple, like over 300, these stocks are underperformers in my mind. 10 years, you should probably be at least, at least 3 times your money, I would say. That's just my guess. But I'll put this in the newsletter so you can see it. What is this one? Let me see. Oh, this is a good TrendSpider video from a couple of years ago. And it goes over is the story of a new day trader and his mission to get rich trading. And it's a good example of how people just get into day trading and stuff. I haven't fully watched it. I like the colors in it. I like the animation in it. But TrendSpider put this out, it looks like 2 years ago. I'll include this in the newsletter. I think it's a pretty good video. So we'll watch that one in a little bit. My weekly stock pick is Cisco this week. And it's not my weekly stock pick, by the way. This is Farouk. Farouk is European, and he makes the My Weekly Stock Picks. We are two separate people, just so you know. But Cisco is his name for this week. He's got an algorithm. Let's go look up his newsletter. I think it's My Weekly Stock Pick. myweeklystock.substack.com. His performance, so far he's down 2% in this year. His performance last year is what blew me away. Remember, the S&P was down 13%. The Dow was down. He was up 13%. This is just buying on a Monday, and it's 30 stocks. So it's not a ton. Cisco, in my mind, great quality stock for a tech. It is not overvalued. If we go over here and we look at this one, it is, the PE is 18, right in line with the S&P. The forward PE is only 13. So if they grow to where they expect to grow, you're going to come up to that 18 and you're going to see growth. Plus, you get a 2% dividend to hold on to it. The average price target is 57. Right now, it's trading at 55. The performance year to date is up 16%. I don't know that I'd necessarily buy in at 55 and hold, but this week so far today, I think you're up slightly. I can't see the percentage on my thing, but yeah, it's my weekly stock pick. If you're not subscribed to his newsletter, just go to myweeklystock.substack.com. But it's a great, he's got a great algorithm. Dave from YouTube asked me, TTT. Let's look at TTT. I think this is the inverse of the 20-year bond. I think it was what? Ultra Pro short 20-year treasury bond. Yep. So you can see, I mean, this isn't one that you necessarily day trade on. You can see the interest in the volume just spikes. I mean, it just goes nuts on certain days. This is the 4-hour algorithm, and you can see we're still in at 69.01 from July 25th. So it correctly said, hey, in the month of August, rates are going to go up. And so this is the short of the 20-year treasury bond. The 20-year actually has been going down slightly. And then now, starting August 22nd, when we really saw some selling, you're seeing it go up. So this is the short of the 20-year treasury. I don't know how it works. I don't know if you want to get into this, Dave. I know nothing about bonds. I'm just a douche on the internet. My guess is when the algorithm tells you to get in, you get in. Now, the algorithm hasn't been right on this one. Performance of this one is 82% over 2 years. The actual asset, if you just bought and held it, 152%. So it almost doubles by just buying and holding. But that's what you get in a rising rate environment, is if you get in and out, you just underperform the actual asset. And that's a great thing for you guys to know too. If you're picking stocks and you get in and out, you tend to underperform the asset. Yes, you're safer. So the 82% is great because your safety margin is, hey, at least I know I'm winning 45% of the time. I'm losing 55% of the time. But if for some reason you buy at like, say, 87, you just say, hey, FOMO, I'm going to buy at 87. And then it drops down. You just, yeah, it's just But I don't know, Dave. I'm not a bond guy. I typically don't do ultra pro shorts on treasuries. It's a protection strategy. I'm not that good. I'm just not that good. So, but I can tell you today, as far as triple levered goes, TQQQ is the one to get. I think, are we still in TQQ? I think it had a trigger last week, if I was right. Let's see. Let's look at the 4-hour algorithm on TQQQ. Yeah, up week. I think it is going to be an up week, but let's look. Yeah. TQQQ bounced off the 200 day, 37.98. So you're at 38.73. Again, 40. In my mind, this right here at 40, let's go to 40. This is your buy. Let's go to 40. This is your buy right here. So when you get below it, you buy it, hold it. I mean, you could have held it the entire time here. When you get below it, I think you buy it, and I think it gets back up there. But I think you have to pull the trigger on around 40. So I like that strategy versus buying treasuries and stuff like that. Let's go over some scans. MPLX, this is the, I think it pays a 9% dividend. This is an energy multi-partner. I don't know what it stands for. I've owned this one. I don't know that I necessarily get into it just to kind of buy and hold. It's been up there, but you enjoy an 8% dividend while it pays. And these guys have been paying that dividend. No matter what, they pay that dividend. Even during COVID, they paid the dividend. Coke, KO. I say wait till it gets under 60. It's at $60.66. It's a bit extended. I do think that 60 is, if you're going to buy long-term, just buy it. I mean, the algorithm doesn't necessarily do you any favors. You lose 3% over 2 years versus buying and holding makes you 8%. This is just a steady stock. I mean, they're going to get hurt in a recession if a recession comes, but you just buy it and you hold it. Again, I drink Coke, I drink Pepsi, so I have both of them. And Pepsi kind of crossed up last week. Bank of America, I'm going to be adding to this one. It's under the 200-day, 28.51. You're at 28.84. I think there's more bad times for the banks, but I think Bank of America is going to come out of it perfectly fine. Another bank that we talked about, looking at the book value, which I think is like $319 or something, it's getting damn close. Let's look at Goldman Sachs. What's their book value? They're having some issues. There's not IPOs. There's not stuff. Book value is 309. So you're not quite there. It's 309. 320 it gets you in. You're under the 200-day. Remember, dollar cost average your way in. Don't buy all in at once. Figure out what lot size you want and then just, divide it by 5 and add it in. If you want to add it in over a week, add it in over a week. If you want to add it in over, 2 weeks or a month, add it in over a month. That's how I'm going to get into NVDA. I talked about that in the paid newsletter. Morgan Stanley. I mean, again, financials, they've been beaten down. I don't think that, the problem you're going to have is that Jay Powell is probably going to raise rates in September. The market is only counting on a 17%. 17% of the people think it's going to raise. So when he raises in November, these financials could absolutely go down. It's a crazy bad time to raise interest rates for banks, because essentially what banks have to do is they have to compete for deposits. So people are buying bonds, people are buying CDs, people are buying things of that sort and not depositing their money in the bank. So the bank has to pay higher interest rates to incentivize people to actually put their money in. So banks might be a risk. I own Morgan Stanley. I own Bank of America. I own Wells Fargo. I own all that stuff. An energy company that got a cross up is Diamondback Energy, FANG, F-A-N-G. FANG is energy. I mean, I don't know. Pounding the pavement on energy. This one has done great. I mean, just enormous. Look at that. June 27th, 127, and you're up at 149. And I think you're getting like an 8% dividend if I'm right, 7% dividend, 4.6. So it's come down. But it's up 11% year to date. Name an energy company that's up 11% year to date. FANG got one. We had a couple cross-ups on levered ETFs. Meaning they're just levered against some type of indices or something. This is UMDD, Ultra Pro Mid Cap 400. This one looks like it's using the 200-day as support right here. 1892, you're at 1918. I would be careful with these. Some of these, like UMDD, probably doesn't have a huge float out there, so the volume connecting buyers and sellers in the market might be a little bit tough. So be a little bit careful of that. The one that I wanted to point out is DPST. If you guys know, this is the triple levered regional bank bull. So this says, regional banks are gonna go up. We had this one go from 57 back here in June all the way up to the 80s with a 44% gain. 62.43, it's bouncing off the 200-day. So if you're using that 200-day as support, you could get back up there. 62.43. It's at 65 right here in the market right now. The only spider sector that crossed up is XLP, which is the consumer staples. This one, I've got consumer discretionary, because consumer discretionary actually includes Tesla, to be honest with you. That's the reason why I have XLY, and that's why I have it in the core portfolio. Consumer staples, XLP at 72. If you wanted to get into that one, we've seen the consumer, all the retail sales that you're seeing. That's why this one went from 76 down to 72. So you're seeing that one slip right there. I won't go over some of these charts, but Fiverr, NEO, SMMT, we talked about with that $500 billion buy or $1 million buy. Procter & Gamble, Intel had a cross up. 3M had a cross up with some settlement. Enphase, which is solar, had a cross up. Duke Energy, one that I do want to bring up that I'm a little bit hesitant about. I got rid of my Schwab in the 60s. Did I get rid of it? I may have gotten rid of it. No, it's in my brokerage account. I'm sorry. I still hold that one because I wanted it for long term. So I did not get rid of it. It has a buy here at 58. You could have gotten out on the algorithm and I said anytime this one dipped under 40 back here, I think I wound up getting in at around 48 back here. But I haven't sold. 66 was its high. They do have some issues. Just like every other bank, they have some issues with the deposits. This could leak into some of their other business, the long-term versus short-term. I don't completely understand this stuff. Just understand that they do have issues. I don't think it's going back to the 40s. But with a banking crisis, I think you could see this one pull back significantly. But I do think that we're going back to the 60s. You're at 59.06. I'll probably add to mine here just because I do like it. But I will not add big. It's not where I'm going huge. Citibank, or as the Chinese chef on South Park says, shitty bank, got a cross up. And this one is another bank. Again, if you can tell this one, it's just another bank that's been beaten down. This is at $41. They have other problems other than just interest rates. So just understand it's still a semi-broken bank. But I think the new CEO is doing all she can to kind of do everything. I mean, that RSI down there is bouncing off the 23 level. It's now at 28. The MACD's crossing up. Probably not bad to come up here and cover that gap at 43 or so. So I like that one. We had some covered call ETFs, which are RYLD, QYLD, XYLD, DJIA, and DIVO. All of those crossed up. And Vanguard entries, VYM and VTV. So if you have any questions, hit me up. Again, TrendSpider sale is going on. If you want, go to my link tree. You can join the private Facebook group. You can join Twitter. You can join Instagram, YouTube, whatever you want. Visible, $20 off your first month. The one that I would tell you to click on that actually everybody should do, if you're in Robinhood, if you're in any of these crappy brokers, click on Webull. Deposit as little as $3 in Webull. $3 in Webull. There's links in every show description for Webull. Put in as little as $3 and you get up to 12 free shares of stock. It's fractional shares. Typically, I've gotten Snap. I've gotten Starbucks. I think I've gotten Ford. I've gotten a bunch. None of them are working out because none of them are really good stocks, and I always wind up getting them at bigger prices. But let's do a Webull check. I put $1,000 in there at the beginning of the year, and I'm going to be donating the money. I'm at $1,939. So anything that I get, I'll donate. I've bought the three stocks that I've really bought: Caterpillar, Apple, and Boeing. Those are the three that I've bought in there. I've got Gap, I've got Starbucks, I've got Google, I've got Procter & Gamble, Coke. These are all stocks that it gave me. Ford, Snap, Spotify. But I bought Cat, Apple, and Boeing. And I'm up, I'm up 4% in Caterpillar. I'm up 25% in Apple. And I'm up 3% in Boeing. So, but Webull is one that I would say take a buy on. You can gift me on any of the platforms with Venmo, PayPal, Cash App. I'm also going to start, I think, a Buy Me Coffee because I like that program. I saw that program for some creators, and I gave somebody a cup of coffee. So I'm going to start that. But yeah, Linktree has everything. If you have any questions, hit me up. I will be back. I have a 1:00 doctor's appointment. Let's hope my pain goes away a little bit. I woke up moaning today, just so you guys are aware. Yeah, it's a little bit painful. Okay, take care. See you guys.